really understand how financial statements connect with each other, or are you just memorizing them? We uncover company health through the balance sheet, income statement, and comprehensive income. Welcome to your CPA School. In this lesson, we are going to discuss about the full set of US GAAP financial statement and understand how they work together as an integrated system. Under US GAAP, companies prepare a complete set of financial statements. A statement of financial position means balance sheet. A statement of earnings means income statement. A statement of comprehensive income. A statement of cash flows. A statement of owner's equity, and notes to financial statements. Each one answers a different question, but together they tell one complete story. The financial statements and integrated system. They are deeply connected. The story begins with performance shown in the income statement. That performance directly affects the balance sheet. And then comprehensive income completes the full picture by capturing all non-owner changes in equity. Assessing financial health at a point in time. The balance sheet provides a cumulative picture of a company's resources and obligations as of a particular date. It shows assets, probable future economic benefits, liabilities, first claim on assets, and equity, what's left for the owners. And it is built on the fundamental equation, asset equal to liabilities plus equity. Accounting equation, asset equals to liabilities plus equity. Assets, liabilities, and equity. Three variables, right? Assets are used to evaluate company liquidity. Liabilities are used to evaluate company solvency. Equities are used to assess capacity. So what is the question? Can the company meet its short-term obligation? Short-term obligation indicate liquidity. So in this case, we need to observe current asset versus current liabilities. If current asset divided by current liability, it shows the liquidity position of a company at a particular point in time. Can the company meet its long-term obligation? Long-term obligations equivalent to solvency. We assess financial risks, debt versus equity. What is the company's capacity to produce and grow? We need to see tangible versus intangible assets. Where does the company stand at a point in time? It indicates financial position, right? Go for the statement of financial position or balance sheet. It helps us assess three technical areas: liquidity, financial risks, and capacity to produce and grow. The income statement or a statement of earnings answers how did the company perform over a period. It reveals performance, operating risks, and growth potential. Now here is where many students get confused. The statement of comprehensive income answers what is the full change in company value. It includes net income and other comprehensive income. This is where we capture non-owner changes in equity. The cash flow statement answers where did the cash come from and where did it go. It helps us assess quality of earnings. The statement of owner's equity explains how did the owner's stake change. It includes capital contribution, retained earnings, and comprehensive income effects. Now that we understand the framework, let's test your understanding. Try solving this question. Focus on how discontinued operation and taxes affect net income. Scenario 1. A company's draft income statement for the year ended December 31st, year 5 reported $370,000 of income from continuing operations before tax. The following items were excluded: loss on sale of property, $160,000, income from discontinued operations, $90,000. The discontinued operation is expected to be sold within 6 months. If the company's income tax rate is 20%, which of the following amounts should be reported as net income for the year ended December 31st, year 5? So which of the following amount should be reported as net income? That is all of the questions. We need to calculate the net income. There are four options. Option A, 368,000. Option B, 240,000. Option C, 296,000. And option D, 168,000. So here, if we look, so two items were excluded. One is loss on sale of property, which is part of continuing operation, and the other one is income from discontinued operation, which should be reported net of tax. And here is the tax rate, 20%. So we know part of continuing and discontinued operation both are part of the net income. So we need to calculate it. So draft income from continuing operations before tax, 370,000. Less loss on sale of property, 160,000. After deduction of this, we get 210,000 income from continuing operation before tax. Now we need to pay tax. Tax rate is 20%. So 20% of 210,000 equal to 42,000. After subtraction of 42,000 from 210,000, we get income from continuing operations 168,000. Now you need to consider income from discontinued operation. Remember, it should be reported net of tax. Net of tax means after deduction of tax. So tax rate is 20%. So 80% we need to calculate it. So 80% of 90,000 equal to 72,000. That should be reported. So in total, net income will be 240,000. So if we see over here, we see option B is the correct answer. This question tests your ability to identify what goes into net income versus other comprehensive income. Remember, unrealized available for sale securities gains goes to OCI, realized gains goes to net income. Let's see the scenario 2. A company's activity for year 2 included the following: gross sales 3,600,000, cost of goods sold 1,200,000, selling and administrative expense 500,000, adjustment for a prior period under statement of amortization expense 59,000, sales return 34,000, gain on sale of available for sale securities 8,000, gain on disposal of a discontinued business segment 4,000, unrealized gain on available for sale debt securities 2,000. The company has a 30% effective income tax rate. What is the company's net income for year 2? So this is call of the question. What is the company's net income for year 2? So we need to calculate the company's net income. There are four options. Option A, 1,316,000. Option B, 1,273,300. Option C, 1,314,600. Option D, 1,267,700. So let's analyze the question. First one, adjustment for a prior year understatement of amortization expense 59,000 should be excluded while calculating the net income. Why? Because it is related to adjustment regarding the prior year. So there is no relationship with the current year company's net income. And the second one is unrealized gain on available for sale debt securities. It should also be excluded because it should be reported on OCI. So while calculating the net income, we need to exclude this one. So now there is another is 30% effective income tax rate. It is required, right? Because we need to calculate income tax. We also need to calculate the net of tax of discontinued operations. So let's start. Sales minus sales return equal to net sales minus cost of goods sold equal to gross profit. So we can calculate it by figuring the sales is 3,600,000 minus 34,000 minus 1,200,000 equals to 2,366,000. Now subtract selling and administrative expense 500,000. So operating income will be 1,866,000. Gain on sale of available for securities. This gain indicates it is a realized gain. That's why, although it is related to the available for securities, as it is a realized, so it should be reported on the net income. So income from continuing operation 1,874,000. So now you need to pay 30% income tax on that amount. So 30% of that amount equal to 562,200. So now income from continuing operation 1,311,800. Now we need to consider the discontinued operation. It should be reported net of tax, means after tax deduction. So meaning that 70% we need to count it. So 70% of 4,000, 2,800. So as it is a gain, it should be added. So what is the net income? And the net income is 1,314,600. 1,003,000. No, 1,314,600. Where it is? Option C is the correct answer. So scenario 3. In this example, we will discuss about selling expense. A key principle to remember: focus only on cost directly related to selling activities. Let's see the scenario. Rock Corporation reports operating expenses in two categories: selling and general and administrative. The adjusted trial balance at December 31st included the following expense and loss accounts: accounting and legal fees, advertising, freight out, interest, loss on sale of long-term investment, officer salaries, rate for office space, sales salaries and commissions. One half of the rented premises is occupied by the sales department. Rock's total selling expenses are A, 360,000, B, 400,000, C, 370,000, D, 480,000. We need to look for the correct option. So now we need to analyze the question. We see operating expenses they provided in two categories. One is selling, other one is general administrative expenses. Additionally, they say one half of the rented premises is occupied by the sales department. So one half of the premises used by the sales department, meaning that one half of 210,000 equals to 110,000. So 110,000 of rate is allocated to selling expenses. So our call of the question is total selling expenses. So now we need to classify each expenses. So accounting and legal fees. Is this related to general and administrative? So it is cancelled. Advertising, it is related to sales. Freight out, it is related to sales. Interest, it is related to financial charge or non-operating. It is cancelled. Loss on sale of long-term investment, it is also non-operating. Officer salaries, it is general and administrative. Rate already calculated 108,000. Sales, salaries and commissions 140,000. So we need to calculate the total selling expenses. So calculation of total selling expenses. First one is advertising 150,000. Freight out 80,000. Rate 110,000. It is calculated already here from sales, salaries and commission 140,000. Total 480,000. So the correct option is letter D. Understanding financial statement is not about memorization. It is about seeing the connection between them. Once you understand the system, everything becomes easier. If this helped you, please like the video, subscribe, and press the bell icon. At your CPA School, we believe concept first, confidence always.